Hello and welcome, everyone. My name is Alex Gribe. I'm responsible for market development across Refinitiv's trading business in EMEA. I'll be your moderator for today's webinar titled Foreign Exchange News and Currency Analysis in association with our colleagues at Reuters. Before I introduce the speakers, I'd like to just cover some housekeeping points, which I'll just bring on the screen right now. So what you'll notice is at the bottom of the webinar screen, you should see a toolbar. Use the toolbar to access a range of applications, such as the speaker biographies, some additional resources, technical support if you're having any issues. All the apps on your screen are resizable and movable if you need to put them somewhere. Please submit any questions you have throughout the webinar in the Q&A box. We'll try to answer as many of these as we can throughout the webinar, or if we don't get a chance, we'll answer them after that. For the best viewing experience, we recommend you close any other programs, browsers running in the background that might be using up your bandwidth. That helps conserve bandwidth and you get a better experience out of the webinar. Some networks cause slides to advance more slowly. Then essentially the recommendation there is if you have a VPN and you log out of that, then straight internet will give you a better bandwidth. We do value your feedback, so please do try to complete the pop-up survey right at the end of the webinar. So that said, what are we going to talk about today? So as we all know, basically March and April has seen a considerable spike in volatility. We've seen volumes, trading volumes in foreign exchange, not just trading exchange, but all assets spike. We found traders finding it increasingly difficult to manage risk. We've seen spreads widen. We've seen an increase in the cost of trading. We've seen a flight to quality, not just in terms of the assets, the currencies, but also the sort of venues where they're traded. But certainly we've seen that in the currency markets. Then this was followed by a drop in May, right? So April, May has seen volumes sort of drop off, but now in June, we're seeing the trading volumes start to edge up again on our platform with a ensuing stabilization in the currency volatility index from April. So ultimately, what can we expect the next 6 months and being what's being termed essentially as a potential recovery phase? So to tackle this question, what next? I'm joined by a distinguished panel, which I will introduce. I'll start with Vidya Ranganathan. Vidya is a breaking news editor for Reuters. Breaking news provides the latest real-time market impacting news. Vidya is based in Singapore. She leads the coverage of our global spot news. And previous to that, she had a career at Societe Generale in Asia. We've got John Noonan on the line. John is the senior analyst for FX Buzz Reuters. FX Buzz provides FX market analysis, trading outlooks, recommendations. It's delivered by a 20-strong team of experienced market professionals that provide a neutral, unbiased view round the clock. John leverages 47 years of experience in foreign exchange markets, holding senior positions at a number of banks around the globe. Last but not least, we've got Yuan Chu. So Yuan is also an FX analyst at Reuters Buzz. Now, Yuan covers Asian FX markets with a specific focus on China, right? So in the context of this webinar, it's key to go back first to the first region, effectively, that was both into and now recovering from this recent market shock. So something to look out for. Yuan was previously an FX NDF dealer at both Barclays and ANZ. So that said, let's start and let's just jump in. First question, really, John, I'd like to start with you, and I'd like to take a step back in terms of how this crisis has unfolded and the initial impact of COVID-19 in the wider market context, and more importantly, what are the lessons we've learned from this unprecedented event that we can use for navigating the uncharted waters of this global pandemic, particularly when there's so much talk about second waves and so on?
Thank you, Alex, and hello, everyone out there. Yes, well, one thing we did learn is that it was the ultimate black swan event. I think if somebody had said in November or December, what is the one thing that's going to affect markets next year? I think if somebody said a global pandemic, nobody would have listened, nobody would have believed them. And so it's something that came out of the blue. And when that happened, markets become completely unhinged. We saw this in the FX market. We saw it across all asset markets. You can throw fundamentals out the window. Data is all backward looking. It means nothing going forward. And the fact that this was a very unusual black swan event, as we call it in the markets, when you don't see it coming, we didn't really have any history. I mean, it was the Spanish flu of 1919, but even I wasn't around back then. So this was a very unusual event. And so basically all the trading tools that you normally would use, buy low, sell high, work out the fundamentals, what are the interest rate differentials, how the corresponding economies are doing, and basing your views on that, really do not work very well at all. So what I found out many years ago, about the mid-'80s, I was already a trader since '73, and I found that I had some pretty great losses in between some good trading, but the losses always came during these black swan events, surprise election results, paradigm changes in the market, when suddenly all hell breaks loose and you really have nothing to go on. And so a friend of mine in Chicago, who's a commodity trader, told me about this one very simple system. It's extremely easy to explain and to navigate your way through times like this when fundamentals don't work and price action is unhinged, as you described it. So the first, I'm going to use the Australian dollar because the Australian dollar is a risk currency. It reflects, we call it the fear gauge of the market. So when the markets are quiet and going well, the Australian dollar tends to do quite well in those times. But when markets do become unhinged and everybody panics and hits the sell button, it's the Aussie that really takes the brunt of it. And what we saw when the pandemic started, and even before that, when it was first, coronavirus was first discovered in Wuhan, was that the Aussie dollar had a very close correlation with global equity markets and the S&P in particular. And as you can see, the chart that we're showing right now, the movement's very, very close. The moves up, move down, move back up again, very closely correlated with the S&P 500. So to very quickly explain, and as clear as I can, the system that I use is a form of turtle, or a variation of what they call turtle trading. So what happens is when news comes out that you don't quite understand, the market's going to panic, everything comes unhinged, you basically try to find a system that identifies a trend and just go with that trend and ignore what you hear about experts saying that, this is Armageddon, or some people say it's a buy opportunity. You just get very confusing. You lose a lot of money. And so this system that I was introduced to in the mid-'80s still works at times like this. And basically, you're looking for the trend, and it's using moving averages. So when the 5-day moving average turns below the 10-day moving average, and the 10-day moving average goes below the 21-day moving average, that's a bearish formation. When they all start tilting lower in the same direction, that means that we've got a trend underway. And I'll show you in the next slide, you can see this. So you've got the first sell signal using that system. So the 20-day moving average is in blue. The 10-day moving average is in that burnt orange color, and the yellow line is the 5-day moving average. So you can see they all started coming down in a bearish formation with the 21 above the 10 above the 5, etc. When the price was at 68.25. So what you do then is you ignore everything else and you stay with that position. And as long as it doesn't go above the 21-day moving average, which is where you would put your stop loss, and you can see here that it didn't, you stay with that position no matter what you hear, no matter what you see, because discipline is a very, very important part of using this technique. And then as you can see, then the signal that the trend is ending is when the 5-day moving average starts to move up. That shows that the trend is exhausted, and that's when you exit the position. And so the 5-day moving average started moving up when the Aussie was at 66.25. So you got short at 69.25, and you took your profit at 66.25. And that happened in around December, and that was when the virus, the coronavirus, was first reported in China, and there was movements. There was a reaction in the market, but it hadn't yet reached the pandemic, so it wasn't a panicking move. Then, of course, you can see after a little bit of consolidation, that same formation occurred again with the 21-day moving average in blue, the 10-day moving average in orange, and the 5-day moving average in yellow. Got an bearish formation. They all started pointing down, and that was at 65.15. And that was around March, and that's when the pandemic really unhinged markets. And you can see the ferocity of that move. And you can see the price never went above the 10 or the 21-day moving average, so you weren't stopped out at all. It moved all the way down to from 65.15 when the trend started down to 55.10. And the thing about this system is you're never going to catch a top and you're never going to catch a bottom. And so even though it would have been nice to take profits at 55.10 for an enormous profit, you have to wait. You have to be disciplined, and you have to wait until the 5-day moving average turned higher, which it did at around 59.50. So again, quite a nice profit. Now, some people actually like to use other techniques to when to exit the trade. They might enter the trade using the technique that I just described, but to exit the trade, sometimes they will use, if you're familiar with Bollinger Bands, so if it reaches the bottom of the Bollinger Band, they may reduce the position or get out of the position. And I used to use the relative strength index on a 21-day wider smoothing. And when the Aussie went down to 55.10, the RSI went down to 1432, which was the lowest level for the RSI, the most oversold reading on the RSI since the Australian dollar floated in 1984. So I would have been quite tempted not to get out of the position, but I probably, if I was trading and I wasn't hedging and I was just trading for opportunity, I probably would have taken part of the position back, because very often when you see oversold readings to that extent, you will see the big bounce back, and you'll see that in another slide later as well. But forget about that for now. We'll just use the system that I described. So the 5-day moving average started turning higher around 59.50, and that's when you get out of the position. So the next slide I'm going to show you is, and I think this is even a harder move. So when we went down to 55.10, okay, we were oversold, the market bounced back, things normalized a little bit, but almost every single commentator, including myself, most of the major banks said this is a bear market correction, that we probably will go back and test the old lows again. Global growth is still, it's going to be very awful for the rest of 2020, and more volatility is set to come. But the system I use gave us a different reading. So as the Aussie was bouncing back, instead of telling us this was a opportunity to sell, it was now giving buy signals. The first buy day signal came at 63.25, because the 5-day crossed above the 10 and the 10-day crossed above the 21. They all started pointing higher, but it wasn't a very strong. It wasn't a very strong move. And they started even though it went higher, it started crossing again, and basically you got out of flat. No harm. Okay, maybe with some slippage you lost a little bit of money, but not very much at all. But then the second buy signal came when everybody was saying that the Aussie should go down. It's never going to go back to the pre-COVID-19 levels of 70 cents. And the buy signal came at 65.30. Again, the 5-day moved above the 10 moved above the 21. And we stayed above the 10-day moving average and the 21-day moving average until it crossed again at 69.50. Again, you've got to be very disciplined. You can't take your profit until that happens. And when that happens, that's when you get out. And then you can see after that, we had a period of consolidation where there were absolutely no signals at all. So at that point, you don't do anything in the market. So it was quite unique that this system gave you opportunities to make money on the way down when everything was becoming unhinged, and also was quite profitable when the market moved up. Again, going back to the RSI, this is on the next slide, the relative strength index. When the when the Aussie got up to around 69, got above 70 cents actually, we had an overextended reading on the RSI, overbought reading above 70. That shows severely overbought. Again, I may have thought about taking profit, but it wouldn't have mattered anyway because the 5-day moving average crossed around the same time at around the same level. But it's just something else that you look at when you do these positions. So during that period, I worked it out that using that system, you got a return of about 17 or 18%, which is pretty good. And if anybody wants to back check it, they can. You can say that some of the entry levels might be questionable because of the lack of liquidity, so there's price leverage, et cetera, But basically, the bulk of those moves, give or take, 1%, you gained about 17 or 18%. And that's from a trading point of view. From a hedging point of view, it's certainly, if you had a portfolio that you wanted to hedge against what was going on, it certainly would have allowed you to sleep a lot better at night, knowing that you had some cover on and it would have provided you some protection. So, okay, now we'll have a look at what's happened more recently. So this is so we had this period of consolidation after we took the profit at 69.50. And just in the last few days, we've got another buy reading, another buy signal. The 5 days crossed above the 10, the 10's crossed above the 20. They're all pointing higher. And so as we sit here right now, the Aussie is another short-term trend higher. So now you're long again. And you've added about, so far, it's currently trading around 71.30 or 40. You got in at 69.70. And so so you're really up to about 20% now since the middle of December of last year. So it's a pretty good return in markets that are very, very difficult to read. The RSI is a little bit, it's getting towards the overbought level, but it's not really flashing any red signs yet. So you're still in the position. The 5-day moving average is starting to flatten out. So it's something to watch. But the trend is in, and unless it goes below that 10-day moving average, it actually looks like a fairly good position. And the other slide I wanted to show you is the euro. So we had, I'm not going to bother going through all but you can see using that same system, the euro had an uptrend, and then the RSI went above 70, and you would have been a hero. This is back in February, March, if you had sold when the RSI was overbought and above 70, because it fell precipitously. I think it was about 7%. And then we've been in a period of consolidation. But very recently, again, the euro is in a very strong trend higher, according to this system. The 5-day is above the 10. The 10-day moving average is above the 20. This is a day old, so the euro is actually higher than where it shows on this chart. It's about another 70 or 80 pips higher from here. And you've already made pretty good money because the entry point was 112.95 and it's trading around 117.30. So it works. It not only works on the Aussie, it works across a lot of different currencies. The warning, there is a bit of a warning right now, a flashing red light, because the daily RSI is above 70. And as we saw back in February, March, there was a big fall after it reached there. But this time it actually looks a bit sturdier. And I would not be selling. Now I might sell part of the position because the RSI is a bit hard, but I certainly wouldn't sell out of the entire position because the trend looks strong unless it goes below that 10-day moving average or the 5-day moving average starts moving lower again. So before I finish, I'd like to conclude by saying that this is not a magic formula. It's been around for ages. If you were to use this form of turtle trading using these moving averages in 2019, you wouldn't have made much money at all. The markets weren't trending. It was a mean reversion market. We had very defined ranges for most of the year in most of the major currencies. So if you bought low and sold high, you did better. If you tried to follow trends, very often you get frustrated, and this system probably would have either done nothing or probably would have lost a little bit of money. So it's horses for courses. It's part of the toolkit. You don't use a hammer to change a light bulb. So This is a system that you wheel out when markets do become unhinged, when fundamentals do become confused, when there's paradigm shifts in relationships and correlations. This works quite well, and it allows you to turn off the noise, not panic, stay calm, and simply follow the disciplines. I think we're going to have more of this. We'll talk about it later, but we're going to have the U.S. presidential election, and I think there's going to be probably some volatility around that. Of course, there's going to be Brexit, and the U.S.-China trade, or the U.S.-China tensions are ratcheting up, which could lead to more trade tensions as well. So when the markets start becoming volatile, when things start to change, if gold blasts through 2000, when there's paradigm changes in the asset classes, this is a very good system to use. Hopefully, it will help you. It definitely helped me in the later part of my trading years when markets became unhinged. And I would be happy to answer any questions if anybody poses them. So, Alex, that pretty much does it for me. And thanks to everybody for listening.
Thanks, John. So summarizing, Black Swan event, fundamentals out the window, uncharted waters, more likely to make losses during these Black Swan events, and essentially technicals are your friend of last resort. I mean, we'll leave the questions to the end. There was a question on the line around whether these systems only worked in trending markets. I think you answered that. Not appropriate in mean reversive markets. That's pretty much been answered, but we'll wait till the end for questions. Keep the questions coming in, definitely, and we can change tack a bit. Thanks for that, by the way, John. So given that context, I really like to now look at specifically what's going on in China. And you know, we're hearing that traders may be turning a blind eye for now, to Western efforts to restrain China. We're hearing, obviously all the political pressure, is that really making any difference or not? Should we be bullish yuan? And yuan, if I can turn to you and ask you that question in particular in the context of China and yuan.
Right, yeah. So I'm going to talk about why the yuan is still going to be attractive to many foreign investors, despite the tensions going on and so much uncertainty in the U.S. elections. So essentially, although we are prepared for more geopolitical tensions coming up really soon even, the market is going to find it very hard to ignore the lure of China's growth potential. So I'm going to break that down into three parts, why China is still attractive. So firstly, China is emerging as one of the fastest to recover from COVID-19 related economic contraction. Number two, geopolitical stress is increasing, but the thirst for yield is even greater. And number three, Beijing is aggressively trying to attract foreign investors to come to the country. So before we go into the details of that, let's have a look at some of the charts for the dollar CNY. As you can see on the screen right now, this is a weekly chart for dollar CNY over about 2 years. And as of about 3 weeks ago, we saw the dollar CNY drop into that Bollinger downtrend channel, something that John mentioned earlier. The use of Bollinger Bands is also quite a popular system for technical analysis. So that was a bearish signal about 3 weeks ago when it went down into that channel. And since then, it stayed in that channel, although it blipped up because of that huge Shanghai sell-off last week. So fundamentally, technically, it still looks bearish to me, and it could even expose a much deeper drop if it breaks that Fibonacci level you see on the screen there. So part of the reason why the yuan is still very resilient is, of course, the US dollar, as we're all aware of these days, and no one seems to want the US dollar. And the resilience can be seen in the next chart, where we look at the Shanghai Composite Index versus the dollar CNY on the same chart. So we've seen the Shanghai Composite come off like 3.9% on Friday when China ordered the US consulate in Chengdu to close. Yet the CNY lost only about 0.3% to the US dollar. And for the year, the onshore yuan is only down about 0.5%. At its worst, it was down about 3% this year. So back to the point about the weak dollar, I mean, I think it's been widely publicized that no one thinks the Fed's going to do anything this week, or not for the long run, actually, while there's much uncertainty in the US and they're struggling to recover from COVID-19. So that's part of the big reason why dollar CNY is not going to go up very much. As you can see from that chart, where we overlay the Shanghai Composite Index with dollar CNY, the reactions you see to any drops in the Shanghai Composite reflected in the dollar CNY are very minimal, because it's hard to argue against selling the dollar. So from there, we're going to go to how, even though there's a lot of negativity around US-China tensions, we still see China's economic data coming in pretty strong, in fact, surprising on most fronts. So last week, we had Q2 GDP, which rose 3.2% year on year, and that easily beat the forecast for 2.5% growth. And as much as you can say it's a backward-looking statistic, fact is potential for growth in China still outstrips that of the developed nations. And to throw it forward a little bit more, we had a Reuters poll just earlier this week, I believe, or on Friday maybe, that showed most respondents expect and have upgraded their forecast for 2020 full year growth in China to 2.2% versus a projection of 1.8% as they had predicted in the poll conducted in April. And today, Fitch just said that they expect China to grow 2.7% this year for the full year. So there is some optimism still, despite what's going on in the geopolitical arena. There's in between China and the US, obviously. And why the data has been good is partly because China has been moving towards a more consumption-driven economy. And yes, there has been a bit of a disappointment in retail sales recently, but the transition is still ongoing and it's still going to keep going. And meanwhile, the government is still going to keep spending a lot of money in infrastructure and construction, which has actually probably been the main driver for these big jumps in GDP and industrial profits. So even if there are some worries about how far the West or the US will take their actions against China, there is definitely some optimism still from economists. Which brings me to the next point, the second point about how, despite geopolitical stress, there's a very strong thirst for yield. We obviously know by now that asset prices have been inflated so much, I mean, just looking at gold and stocks as well, that a lot of it is driven by the need to find something to do with the cash that is sitting on the sidelines. Now, in June, China's mutual fund industry saw its biggest monthly jump in new funds since 2015. This data point was also corroborated by Bank of America's research, which showed that investors poured the most cash into China funds since 2015. So there is this wall of cash because of near zero interest rates and global central bank injections that still needs to be put to use. And when it comes to choosing between developed nations and emerging markets, it's kind of almost a no-brainer. And which then brings me to my third point. China is also stepping on the gas pedal to try to bring in more foreign investment. As you would have been aware of last week when the state media encouraged investors to pile into the stock market, saying that the bullish stock market is good for the economy. Besides that, there's also been the hard changes in regulations which have allowed foreign investors much easier access to China's capital markets. For instance, in March, offshore traders hit record volumes on the Bond Connect scheme, which facilitates bond purchases for foreign investors. And in the newly launched Hang Seng Tech Index as well as Shanghai Starboard, is also attracting a lot of inflows of foreign money into the tech sector in China, which ties in nicely with how the US is trying to shut out Chinese companies from listing on Wall Street, which is actually just driving more money to China. So we're going to see the Ant Financial Group and JD.com launch some IPOs, probably in China and Shanghai. That's been a big draw for foreign investors. So that's going to also keep the Chinese yuan propped up, even if not because of material inflows, also because of sentiment. So that basically sums up why I feel the yuan isn't exactly going to be beaten down too much. Firstly, because of the weak dollar, which isn't going to go away anytime soon. And secondly, because there is intrinsic value in exposure to the yuan because of what China is doing, and because of the fact that it's probably going to recover faster than many other parts of the world when it comes to the coronavirus. Back to you, Alex.
Thanks for that, Ewan. So growth and yield are king for investors. Political pressure only goes so far. Consulate closures have had minimal impact on yuan, as we've seen, and cash needs a home. So that pretty much answers that question, Ewan. Thanks for that. Look, I'd like to, at this point, I'd like to go back to the audience, actually, and I'd like to run a poll, if we may. If we can get the poll questions on the screen. What I'd like to determine here is basically what's the greatest threat to economic recovery and return to risky assets, and if essentially, while the audience is making their selection, there are 5 choices here, essentially. So failure to find a vaccine or a cure for COVID-19, the up-and-coming presidential elections in the U.S. this November, the limit on governments in terms of being able to provide additional stimulus to get parts of the economy and certain segments going with additional spending, rising tensions, as we've just heard from Ewan, around China and the West and whether that's going to negatively impact global trade and supply chains. And then finally, back to Brexit, the story that kind of went away. So the inability of the UK and Europe to find a deal effectively. So if the audience, if you can just select your choice on there and feed that through. And while we're waiting for the audience to make their selection, I'd like to just get a view. I mean, perhaps, Vidya, I'll start with you. What do you think we're going to see here? Vidya, John Ewan. Start with you, Vidya. What do you think we're going to see here from the audience? What's your view on this?
Thanks, Alex. So I just feel there's among these, there's the known unknowns and then the unknown unknown. And if I had to put one of them in the unknown unknown category, that would be the vaccine and the COVID-19 progress. Because we know that by November, we will know what's going to happen with the U.S. election. We also know the 2 or 3 scenarios there and how they will play out, whether, Biden and a Democratic sweep of Congress could be dollar negative. Whereas if it's Trump and any of the other permutations and combinations, then we got to look at how corporate taxes pan out, how the whole, how the stock market reacts, and the stimulus. That also hinges on the coronavirus and the wave 2, wave 3, and we know by now that most governments are willing to spend. So that again has a conditionality which is dependent on COVID-19 and its progress. Tensions with China, once again, very much part of the presidential election, and whether it's a multilateral nuanced approach that Biden takes, or whether it's a Trump kind of impulsiveness. And Brexit, that's going to play very much in the euro and pound space, and we know now the euro has got some characteristics of a safe haven currency. So I would say that the unknown is COVID, and therefore, to me, that would be the biggest risk.
Thanks, Vidya. John Ewan, do you want to add? I mean, Ewan, on your side, I mean, given what you've just said, and given we've just seen the poll results come in, interestingly enough, the overwhelming majority to what Vidya just said is failure to find a vaccine. I mean, that's certainly the biggest risk. And then it's followed closely by rising tensions, despite what you've just said. Ultimately, I guess that's overall economic recovery. I mean, Ewan, what's your view on that based on what you just said earlier?
Yeah, there's definitely more emphasis on the uncertainty of COVID right now, because that's kind of like a real medically driven fear. As for people being concerned about China and the West, yes, there is definitely there. People are worried. People are paying attention to it. But that fear is not being reflected very much in the market, as you can see from the charts I put up. The yuan isn't suffering too badly because of that. Stocks do swing around, but as Peter mentioned, the willingness of governments to inject stimulus and to ease can overcome a lot of that. So while the fear is there, it's not really playing out that much yet.
Thanks, Ewan. John, anything from your side?
Yeah, I totally agree with what the poll is saying and what the video is saying, that I think the U.S. election will create some volatility. If there's a Biden victory and the Democrats sweep, there'll be some concerns about, uncertainty about what's going to happen with the corporate tax, et cetera, et cetera. But I find with elections, particularly U.S. elections, there's usually two reactions. One is the impulsive sell, and then it's the big recovery. So remember, before the Trump was elected, everybody said asset markets are going to crash, and then the stock market was at an all-time high in about 3 or 4 months. So I think there'll be some volatility, but we kind of know what the scenarios and how they're going to play out. And I really doubt if there's going to be a radical change to the agenda, no matter what comes out. But definitely, it's the COVID-19. One thing that we do know is the market has priced in that the COVID-19 vaccine will probably come along, or a cure of some description will probably come along in a timely fashion. If that is not the case, and we have to learn to live with COVID-19, a V-shaped recovery is out of the question. We may see a W or U, a very elongated U-shaped recovery, and that will definitely be a threat to not only the economic recovery, but some of the market assumptions out there. So totally agree with the audience on that one.
Great, thanks, John. So look, that said, again, I guess it's a question around what happens next. So a couple of things on the topic of flight to quality, which we've seen with the immediate impact of COVID-19, and ultimately there's this question about recovery now. So again, March and April showed flight to quality across all assets, all markets, but again noted in FX, as we said at the beginning. So the question, Vidya, I'd like to ask you is this likely to unwind now? What do we believe is the appetite for getting back into risky assets and risky currencies as an immediate move from the market? And then I'd like to follow it up, if you could, in terms of the outlook for the remaining 6 months, based on what John just said on the U-shaped recovery, the longer U-shaped recovery.
Sure, thanks. So I think, the nature of markets these days is how much can change in a week. And if you had asked me the same question last week, I would have given you a totally different answer. So what we saw, and I'm just going to move to one of the slides, what we saw immediately after April and the spikes in March was some of these emerging market currencies, right? And we're talking about the flight to risk, so the move to risk on. And we did see that governments, even though, as John was saying, we've never encountered something like COVID before, but the governments were saying, oh, we've seen this movie before, right? And the Fed unleashed over 3 months the kind of stimulus and measures that it took them 4.5 years during 2018, and that naturally has also shortened the reaction time of markets. So I've got here the green line, the turquoise line, the Korean won, for instance. Between its peak in March, dollar won's peak, or the Korean won's bottom, to its recovery, and it still hasn't fully recovered, but in a matter of 2 to 3 months, and by the beginning of June, it had already recovered more than half its losses. The Indonesian rupiah, even swifter. It was and if you look at what happened in 2008, it took them 2 years. It was only by the middle of 2011 that these currencies were back to where they were. Likewise, if I've got on this slide all the emerging market currencies, and you can see here that the Chilean peso, Singapore dollar to a small extent, Hungarian forint, Polish zloty, Colombia, South African rand, Brazilian real. These are the high-yielding, risky currencies, right? And they had an amazing second quarter of the year, which is just again testament to the whole idea that markets thought this was going to be a V-shaped recovery. Even if it wasn't going to be a V-shaped recovery, it's a question of FOMO or TINA, or the fear of missing out. There is no alternative. Equities are the only game in town, and so you go into equities. But do you go into U.S. equities? Well, yeah, the S&P 500 is doing really, really well. It's up 45% for the year, closing in on record highs, but it's led by 5 shares, the 5 stocks, the tech stocks. And so it's such a narrow rally, and you're factoring in earnings and valuations into 2021 and 22, which are outright unrealistic, unheard of. And yet, investors, do you put your money in real estate? You cannot in this environment. Real estate is one of the sectors where even the long-term investors are pulling out. Do you then go get into bonds? And if you think governments are almost at the end of their easing cycles, then you have to worry about the duration risk. This is a low inflation or zero inflation and no growth environment. And stocks are the best bet, and it is because there is a momentum there, and there is this expectation that come 2021 these corporates will do something to get earnings. So we saw for instance, the red bars here represent flows in June, and most of the bond markets had gone from being negative to positive in June. In Malaysia and Thailand were in fact getting a lot of money, so as was South Korea. You move on to equities, and for the reasons I just said, people didn't want to be holding on to the 5 narrow US stocks. So there was money coming back into Asian stock markets. So the zloty, the ringgit, the rupee, the peso, most of these currencies were doing really well. And of course, there was some differentiation, but most of and I'm guessing that some of these investments were hedged, but we did see a return of risk appetite. And then what happened within a week? Within a week, we've seen the protests and counter protests and the U.S. political situation, the fiscal debate, causing the bottom fall of the dollar. Okay, that should be positive for emerging markets, but then Europe comes up with its own version of Eurozone treasury with its own bond, which could be the alternate to treasuries as a safe haven asset. And you suddenly thought Europe was a safe place to be, but then you had quarantines and the Spanish outbreak and lockdowns resume again, and you saw gold hitting 2,000. Now that clearly shows, yes, this is a very defining. This could become one of the defining phases in the whole risk appetite situation. The second half of the year was meant to be a return of risk appetite, but what we are instead seeing is people rushing into gold, people preparing for August. And August has traditionally been a volatile, horrible month for US equities. It's been a bad month for emerging markets such as Indonesia. So let's see what happens in August. And we are heading into a period when people are starting to question their investments, are being very selective and asking themselves, what do we do next? Now, coming to the second part of your question, what did we see in driving this move into emerging markets in the first part of the year? It was those 3 things, right? We talked about the vaccine hopes, the huge amount of stimulus, and for emerging markets, the dollar supply was a very, very big factor. And so the amount of money that the Fed was throwing in with its $5 trillion balance sheet, so the dollar supply problem was solved, and then countries were reopening. And now we go into second half with 3 big risks. First big first risk, as the audience identified, is of COVID, obviously. The second one is the geopolitics. And here's where the US elections, the US-China equation, and what that means, what the elections mean for US corporate taxes and stocks, and therefore, are stocks really the good investment? Can we bet on a recovery in earnings in 2021, or is COVID going to push that out even further? So, and the final thing is the biggest factor probably is positioning. And we saw, I think the latest data show that dollar short positioning is already at extremes last seen in April 2018. Euro long positions are also at some kind of 2018 highs. So the positioning, the geopolitics, and COVID, these three are going to now determine what happens to emerging markets. And let me just I mean, we do. When you look at correlations, right? Traditional to 2020 has been an unusual year, but correlations have also shown that how unusual this is, because you would think the normal correlations for emerging markets are one, U.S. yields, but then when U.S. yields are at rock bottom, do they really matter? Yes, they do matter for the cross-currency basis, but the weakening dollar is going to upset that. Number two, oil prices. They're hovering below 50. It's helped at the margin countries such as India, but has the ZAR or the ruble been able to benefit? Not really, because there's so much else going on with COVID. Number three, S&P. The S&P has always been something that emerging market currencies are highly correlated to. And this time we find that because of the narrowness of that rally and because it's the only game in town, the emerging markets are not moving in sync with S&P. And so, if you look at Indonesian rupiah, for instance, and this is kind of an idiosyncratic case, right? So you do find that the highest correlation is with the 10-year yield, because people are going into this market only for the bonds and for the yield. It's a classic carry trade. And if you look at whether it's correlated to the stock market, no, it isn't. Is it correlated to the dollar? Yeah, slightly. But you can see that there is a slight correlation to the euro. If you move to, I've got here the Korean won. The Korean won, slightly different. The Korean won is not much of a yield play, but you see that the correlation with the euro has gone up. So there's a subtle change in correlations. Equities don't matter, US yields don't matter, but the euro, and because of the euro, the Chinese yuan is going to have a much bigger influence on these currencies in the second half of this year. That said, the euro is now becoming more of a safe haven. These currencies are risky. We have to see how this pans out. Sorry.
Brilliant, Vidya. Thank you for that. I think we're approaching to 10 minutes to go for the end of the webinar. So I think at this stage, I think it would be good to go to the audience questions. I know we have some of them that have been coming through as we've been speaking, and there are some initial ones. There are initial ones that are actually relevant to Vidya, the last statements you've been making regarding what the next 6 months of recovery looks like, particularly with some of the risky currencies. We have a question here in terms of, can you articulate the main driver for USD Indian rupee pair in the current scenario? So USD
Sure.
INR.
Yeah, sure. I mean, I have to confess that it's a bird's eye view, because I don't follow the rupee tick by tick. But in Asia, we tend to look at Indonesian rupiah and the Indian rupee together, as they are two high yield currencies. And what 2020 has done is show us that there is a lot of differentiation between these two, between the approaches the governments are taking. The question was about the biggest driver for dollar rupee. I would still say it's COVID, because India's handling of the COVID, India's very minimum response to it, the stimulus, the lack of stimulus, these have been causing foreign money to flow out. That said, you also have the pluses for India in that the oil prices staying so low has helped both the current account deficit as well as the trade deficit. The approach of the central bank is the third and last point I would make, which is that in Indonesia, and if you know the background in Indonesia, they've had a problem with or this challenge of I would almost say that this is the first emerging market to try out some form of modern monetary theory where they want the central bank to buy all the bonds that the government is issuing or at least take up all the interest payments on those. And that has caused a bit of consternation in the markets. They are worried that Bank Indonesia is going to have to keep rates really low in order to be able to kind of cushion the impact that the Bank Indonesia is going to take on its balance sheet. So Bank Indonesia it has traditionally been protective of the rupiah in that it doesn't want to see too much volatility. This time it also wants to make sure that it doesn't weaken. So it has put a floor around 15,000 for the rupiah, and it is trying to make sure that interest rate policy doesn't get in the way of the rupiah or doesn't cause it to fall. Rupee, they've been doing the opposite. They've been buying dollars, and they're almost not sterilizing that because they've got a huge borrowing program, and I think keeping the treasury yield curve, the Indian government bond yield curve, from getting too volatile or from yields from spiking too much has been the RBI's primary concern, which means that they're prepared to tolerate a bit of weakness in the rupee. I hope that answers your question.
Thanks, Vidya. Yes, very comprehensive. I'm just going to move slightly tack, John, perhaps your way. And there's a couple of questions on the wider context, particularly with regard to U.S. elections and the U.S. protectionism. I mean, there's two questions I guess we could group together. One is, do you see U.S. protectionism a major headwind for China risk equities post the recent Pompeo speech? I think it was significant that he gave the speech in the Nixon room. So that's the question. There is also a second question that basically says, what if Joe Biden wins, right? What's the impact on the FX markets? What do we think that's going to, how do we think that's going to play out?
Okay, on the first question, yes, it seems it's a very political atmosphere in the U.S. right now. There has been a very hardline group within the White House for some time, led by Mike Pompeo, the defense secretary. He's been very hardline in China, as has been Peter Navarro, who's a White House advisor. They've been offset to some extent by other advisors like Mnuchin and Larry Kudlow, because they want to see the market stay buoyant, and they know trade wars and tensions with China hurt the markets. However, it seems as if the President Trump at the moment is going with the hard line, is because he wants to make this a big issue in relation to distract attention from his handling of the COVID virus. So I think they're going to push the envelope a little bit with China, and I would be surprised if we haven't seen the last of it. And if it does, I think if it does spill over into more tariffs, which I think is very possible, more punitive type measures, which I think is very possible as the election draws closer, the markets will take a lot more notice of it. Having said all that, I think that this sort of segues into the second question. It doesn't look as if, at this point in time, it doesn't look as if Trump is going to hold office. We've said that before with other elections and been totally wrong. The polls haven't been fantastically good on that. But assuming that the polls are correct and they seem overwhelming, I think there'll be a different approach taken by a Biden White House. I think they will still be tough on China. I think the Democrats have to play the hard line with China. It's very popular with American citizens right now, American voters, to play hard line with China. However, I don't think they'll let it spill over to the trade arena too much, so I don't think the markets will take too much notice. I don't think they'll be as aggressive, and I think they'll be more collaborative. I think they'll work with other countries, maybe to isolate China a little bit, work with the EU, rather than sort of that bilateral approach, which the U.S. seems to favor at the moment. As far as the what the dollar will do in the election, I was reading a couple pieces this week, and it seems that a consensus view from the likes of Bank of America, Merrill Lynch, and a few others I was reading is that probably the first initial reaction will be to sell the dollar. But I think probably after that, or they believe after that, the dollar will recover. In fact, the dollar may even strengthen more if Biden wins rather than Trump, because they don't believe, and I don't either, that they will do away with corporate tax. Obviously, when there's an election, you want to appeal, in the campaign, you want to appeal to your base. And so you talk very tough in that regard. But then they tend to move towards the middle once they take office, particularly if a corporate tax, getting rid of the corporate taxes will hurt the economy. That's not what they're going to be doing. And also, they're probably much more likely to spend a lot more money on infrastructure, fiscal spending. You saw the House Democrats have come up with a $3 trillion package. I think that will probably help the economy and probably help the U.S. dollar eventually. And this seems to be a view that's emerging from a few places now. So I think you'll get two reactions. But at the end of the day, I don't see any. It will fade as being a major factor for markets.
Thanks, John. Okay, I mean, I'm just conscious of the fact that we've got 3 minutes left. There's a number of other questions that we haven't got to, but we'll come back to those directly with you. Certainly, if you have any further questions, you've got our contact details. Feel free to reach out if there's anything that you haven't asked that you'd like to tackle. With that, really, I'd like some closing remarks. Vidya, John, and you, and perhaps starting with you, Vidya. Any closing remarks for this session that we've had today to leave with our audience?
I guess this week and then August, keep your head above water, because I think that'll determine how the rest of the year is going to pan out. So I would say, even if you're getting into emerging markets or risky trades, relative value is the way to go. But other than that, making a big call on dollar or euro at this point seems a little bit challenging.
Ewan, closing remark?
Yeah, Alex. So there is obviously some real fear about China and how the US could go even harsher against China in terms of trade or any other means. But I want to point something else out is that China wants to keep the yuan somewhat stable, definitely not too weak. And we have seen some of that intervention in the currency market, either through the daily fixing of the midpoint to ensure that the market doesn't get too bearish about the yuan, or even direct intervention. So I think if it comes down to that, where the market starts going full on against the yuan, I think the authorities will step in and just arrest the currency. So it's not going to free fall, despite a lot of the implications of even a Joe Biden win at the elections.
Thank you, Ewan. John, last remark?
Well, I think I like what Vidya said much earlier when she said if you asked me last week, I may have had a very different opinion. I think it's very important as we enter the next 3 to 6 month period, to stay very flexible. Don't fall in love with your views. Don't be stubborn about how you assess things now. Be very flexible. As somebody once said, the markets can stay irrational much longer than you can stay solvent. So flexibility, I would suggest, is the best way to approach it.
Thank you very much, John. And thank you to all the panelists that joined us today, and to the audience who've joined us for the session. I hope that was informative and will give you some ideas in terms of, how to engage with the market over the next 6 months. With those comments, I'd like to bring the webinar to a close. You can access our global cross-asset market data, all the insight, the analytics, the market-moving news from Vidya's team, the views from the Global FX Buzz team of analysts, our front-to-back trading workflow, and the deepest FX liquidity pools that you can get access to straight on your Refinitiv FX trading workstations. It is where FX trades. Let us do the heavy lifting for you, please. And should you have any further information, feel free to reach out to us about our FX trading solutions. Thank you all for attending, and bye for now. Have a good day.
Thank you.
Thank you.